If you ask most people who actually runs the economy, they will point to the people standing at podiums. We assume presidents or central bank chairs making grand policy announcements are pulling the levers. But back in 1993, a sharp-tongued political advisor sat in the West Wing and learned a humbling lesson. He watched a brand new administration get completely boxed in, its ambitious spending plans trimmed back by a force nobody had even voted for. He later remarked that if reincarnation were real, he didn't want to come back as a president or a pope. He wanted to come back as the bond market, because the bond market can intimidate everybody. While we spend our time watching a loud, chaotic cycle of press conferences and political promises, the actual limits on what governments and businesses can do are quietly decided by a faceless market of lenders. To understand the true trajectory of the economy, you have to look past that political noise. You have to learn to read the undeniable signal of the bond market. Start with the object itself. A bond is simply a loan, written down. It is a promise that if you hand over your money today, the borrower will pay it back on a fixed date in the future, plus a regular interest along the way. This market operates on a strict mathematical rule. A bond's price and its yield move in exactly opposite directions. Suppose investors get nervous about the future and just want a safe place to park their cash. They rush in to buy bonds. Because so many people are buying, they bid the price up. And because the yearly interest stays exactly the same, paying more upfront means your percentage return shrinks. The yield drops. Now reverse it. If investors demand a better return to risk their money, they refuse to pay top dollar. The price goes down, which mathematically pulls the yield up. This mechanic extends far beyond a single trade. It happens millions of times every single day, all over the planet, driven by massive global banks, colossal pension funds, and individual traders. Moving bond prices are actually a real-time mathematical translation of human sentiment. It is the entire globe collectively pricing out its tolerance for risk. This chart shows borrowing costs across different timeframes. The horizontal axis measures time, from short loans of a few months to long ones of 30 years, and the vertical axis shows yield percentages. Economists call this the yield curve. Most of the time, this curve slopes upward. If you lend your money for 10 years instead of 1, you take on more risk, so you naturally demand a higher return. That upward slope signals a healthy, expanding economy. But sometimes the line contorts. Short-term rates climb higher than long-term rates, and the curve flips downward. This anomaly is an inverted yield curve. Think about what investors are doing here. They're so nervous about the near future that they'd rather lock in a lower long-term rate today. They are actively bracing for things to get worse, expecting the central bank to step in and cut rates to rescue a weakening economy. And the track record here is what makes the financial world freeze. Every single time the yield curve has inverted in the United States since 1976, it has been followed by an economic recession. This signal serves as an early warning, identifying the conditions for a recession long before official government data confirms the downturn. This data dictates the cost of living for almost every household in the country. It leaves Wall Street and lands right on your driveway. When you get a 30-year home mortgage, you probably assume your rate is determined directly by a central bank meeting. The news headlines certainly make it feel that way. This chart shows the actual relationship driving your debt. The flat line at the bottom is the central bank rate sitting steady, while the wilder line above is the 10-year government bond yield. Notice how your mortgage rate perfectly shadows the bond yield, not the central bank. The 10-year government bond is considered the safest loan in the world. If a bank can earn a certain return lending to the government risk-free, they will automatically demand a higher percentage from you, an individual homebuyer who carries much more risk. Your personal cost of borrowing is not handed down by official decrees. It is quietly determined by faceless international bond traders pricing risk in the background. Zoom out to the macro level, and you find that governments themselves are the biggest borrowers of all. Because of that, they are entirely subject to the bond market's rules. When investors look at a country's spending plans and decide those deficits are reckless, they act. They sell off that nation's debt. Financial historians call these investors bond vigilantes. This triggers a devastating feedback loop. Selling drops the price of the bonds, which forces the yield higher. Higher yields make government borrowing overwhelmingly expensive, forcing politicians to abandon their grand plans without a single public vote being cast. The bond market strips away all political rhetoric. It acts as a continuous global vote, where millions express what they truly believe about the future. And they cannot lie, because real money is always on the line. Even superpower nations eventually face a risk premium if global trust in their debt wanes. No entity on Earth is immune to the market's veto power. True power doesn't reside in press conferences or elections. It lives in the silent, unrelenting data of the bond market, the ultimate truth machine.